Hey, good morning. My name is Renier Mankies. I'm the Regional Head for Business and Personal Banking, looking after the KZN and the Inland region. Welcome to our Bidvest Bank Canon Asset Managers joint webinar. Today we'd like to discuss the economic outlook on business and investment in South Africa.
Push the live button, Leila.
I'd like to read the following to you. The impact of COVID-19 crisis is deepening poverty, hunger and unemployment around the world. Both fixed investment and private consumption have been hard hit by the pandemic, amid rising unemployment and evaporating business confidence. Meanwhile, concerns over debt sustainability due to the ballooning fiscal deficit may prompt the country to seek additional IMF support to prevent a liquidity crisis. Today, we will discuss what this all means for the South African economy and how investor confidence will evolve. Thank you. We look forward to insightful and robust discussion. Before I introduce our esteemed speaker, I'd just like to run you through a few house rules. Our speaker will take us through his outlook, and afterwards we will open up for question and answer session. Please type your question onto the Q&A window on the right-hand side of your screen, and we will attend to it. Feel free to ask as many questions as possible within the allocated time, and we will try to get through as many questions as we can. Without further ado, I introduce to you Dr. Adrian Saville, Chief Executive, Canon Asset Managers, a wholly owned subsidiary by the Bidvest Group. Adrian founded Canon Asset Managers in 1998 as an independent investment house. Adrian also serves as Professor of Economics, Finance and Strategy at the Gordon Institute of Business Science since 2003. Adrian, over to you.
Thanks, Renier. Good to be with you this morning. Your intro has painted the perfect backdrop to what I'd like to talk through on our time this morning. Perhaps it won't be remiss or flippant to make the observation that whilst a crisis represents stress, anxiety, periods of rapid change, and very often we don't emerge on the other side of that change in the same form that we went in. I'd like to perhaps make the observation that Canon Asset Managers was born in a time of crisis. It was the Asian and Russian crises of the late 1990s. And the investment world that we went into at the beginning of the 1990s looked nothing like the world that came out at the end of the 1990s. You could think of just the internet as being one of the cases in point. You could think of the falling of the Berlin Wall as another. And each of those impacts represented a disruption for industries and economies. And in some places, the disruption was sufficiently spectacular that the businesses don't emerge in the same shape or form or don't emerge at all. And so I'd like to use the time that we've got this morning to try and bring that perspective, that where are we in this navigation and negotiation of what is an extraordinarily stressed circumstance. The word has been overused, and I'll try and use it just once this morning, unprecedented. That's it. We haven't seen anything like this in the last 100 years. If you want to find this type of disruption and drama to economies, to societies, to business on a global scale, you must go back to the 1930s. And to give you a sense of the extent of the disruption, this first chart shows you the changes in GDP forecasts. And not only is the forecast substantially different from where we started the year, but it is the deepest that we have on record in terms of a global shrinkage. So on the far left here, we've got the forecast for world economic growth. Well, the year started with the term growth, and then it turned into recession. And the most recent forecast from the IMF says the world economy will shrink by 5%. We can flip across to the right-hand side and get the number for South Africa, which is 8%. And I think in good sort of South African style, it's quite easy here to immediately sort of suggest, well, this is the end. -8 is an absolute horror show, and it is. It's off the charts. We haven't seen this type of decline in South Africa's modern economic history. And it might be cold, but perhaps there is comfort in recognizing that the United States is forecast to shrink by a similar number, 8%, and the Eurozone even more, explained by substantial declines in big economies. Germany, Spain stand out in cases in point. The Spanish economy is a 50 million population. Last year they had 80 million tourists, and that tourist collection has just stepped off a cliff. And Germany, exports make up 45% of the economy, and you'll know what's happened to export performance with the collapse in world trade. Interestingly, China, although they started the year with 5, is one of the few economies that actually stays with a positive forecast, a growth forecast for 2020. There are almost no other economies that have positive numbers in the barrel. So the implication at the highest level at 30,000 feet for economies is, in a word, bleak. And that then turns into implications for industry and business. And I found this chart particularly interesting. It gives you a heat mapping, and the more filled in the pie chart is, the more severe the impact is on particular industries or sectors. And you can locate your own business in this. I think it's a really neat synopsis of which industries, which firms are likely to feel the impact most acutely and most immediately. Now, again, to some extent, this is in the rearview mirror. If you're going to be impacted, you've felt it by now. But in places, it's not just the impact that we should be giving attention to. It's the way in which this impact is likely to change entire industry structures. And one of my favorite cases in point is the supply chain. If you think of the way in which supply chains have been harnessed or engaged over the last 10, even 20 years as a point of competitive advantage or as an aspect of competitive advantage, China really set itself apart here through the late 1990s into the noughties as the go-to destination to procure cheap supply. And as the Chinese supply chain became more sophisticated, then the rudimentary parts of the supply chain went to neighbors, and you can think of the Philippines, Vietnam, Indonesia as cases in point. But it really represents a substantial concentration of a source of competitive advantage, that if we are a consumer goods firm, for instance, our competitive advantage resides in the supply chain and manufacturing process sitting in cheap outsourced destinations, offshoring. And our suspicion is that the disruptions and the risks brought by COVID-19 have laid bare the vulnerability of that competitive advantage. That if relying on China as your competitive advantage was your go-to in terms of access to market, a huge question mark has been put over that. So it's not just that your firm might have been disrupted, it's that we suspect that this will change the way in which competitive advantages and business models are brought to market. So let me, in what is overwhelmingly a very glib and dark mood and tough setting, point to an immediate potential prospect for supply chain risk mitigation. That sub-Saharan Africa has an infrastructure that is set up for export market. And yes, that is explained historically by colonial footprint. But It represents an infrastructure that is set up for export market. And some parts of the sub-Saharan economy, cases in point would include the likes of Ethiopia, Rwanda, Kenya, have really set themselves apart in the last 5 or 10 years as being potential contributors to supply chain. And then if we can leap tracks in one swift move and recognize that supply chain is not just physical, it is also virtual. And then immediately geographies such as Kenya, which are setting themselves up as go-to tech destinations, start to become a solution in supply chain. So it is incredibly tough, but there are prospects and aspects that might represent opportunity in this very quickly changing circumstance. I'll come back to that. Before we go there, I think we need to just spend a little bit of time wrestling with or dealing with the real circumstances facing people. So when you talk about an economy that's going to shrink 8%, that's an abstract number. What on earth does 8% decline mean? And I'm going to share with you, just a couple of grabs off social media, which talk about what this slowdown might mean. The 80% falls in revenue for small businesses. Research that was done at the consumer level found that as many as 2 in 10 people had lost their jobs within the first, 1 in 10 people had lost their jobs within the first 3 weeks of lockdown. And then on the right-hand side, a post by Ruth Hall from PLAS. Ruth Hall estimates that as many as 5 million people in South Africa, 10% of the population, will lose their livelihood. Now, admittedly, from a statistical perspective, this number is just not going to be captured because those 5 million are informal. They work in the grey economy. They aren't captured by formal statistics. It doesn't change the fact that 5 million people in the country have lost their livelihood. And that 5 million number corresponds with evidence that we've seen coming from economies as diverse as the United States through to India, where in the United States, 30 million jobs lost, that's 10% of the population. In India, about 130 million jobs. That is about 10% of the population. So South Africa's 5 million jobs representing approximately 10% of the population resonates or corresponds with that global data. We suspect that that will take South Africa's unemployment rate, because some part of that 5 million will be formal sector workers that are measured by Stats SA, is going to take South Africa's unemployment rate from 30% already, a harrowing number coming into COVID-19. It's going to take that 30% unemployment rate up to 40%. And then the implications for business. So the 8% is the abstract number. The 5 million jobs is at the levels of our families, our livings, our livelihoods. And then the implications for business is our go-to, one of the reasons why we convened here today is to make sense of the business environment and to navigate into stronger places. This is a piece of research that Canon has been involved with over the last 20 years or more, and it shows the relationship between world economic growth, that's the gray column, and the blue line is the bottom line profit growth of the world's 2,500 largest companies that make up the MSCI All World Index. It doesn't correspond one-to-one, but it rhymes. That when the one breathes in, the other breathes in. So there's a high correspondence, a high correlation. In fact, about 2/3 of the movement in this bottom line is explained by the gray column. To put that into a more sensible sentence, about 2/3 of the variability in company profit is explained by the growth or decline in economies. And here you can see the impact of the global financial crisis on company earnings. And here is our anticipated impact of the 5% decline in GDP on the world's largest companies' earnings. You can read this against the right-hand axis. It's a shrinkage in company earnings of about 60%. So if you anticipate your earnings are going to fall by as much as 2/3, you are not alone in that experience. And if you're doing better than -60, you're doing better than the world's 2,500 largest companies. There are some sectors that are going to experience substantially bigger impact than others. Hospitality, retail, real estate are obvious cases in point. In the same breath, we anticipate that the recovery in the world economy in 2021, which looks like about a 4% growth rate next year, will also correspond with quite a big rebound in earnings. And this is what's being spoken about as the V-shaped recovery. I'll come back to this in a moment. Let's do the same thing for South Africa. So Cannon's done the same work on South Africa. The gray column is South Africa's economic growth, and this thin greenish line, I think my wife would be proud if I told you this is turquoise. This turquoise line breathes in and out with economic performance. And so here again, well, first you've got the Zuma years. You can see that for the bulk of the last 10 years, there's almost no gray columns. South Africa's economic growth has been missing in action. And with that, South African companies have really been struggling to achieve economic growth. If you read this turquoise line against the right-hand axis, South Africa company earnings have been flatlining for the better part of 10 years. Maybe more of that for another time. For now, the South African economy declining by 80%, that's the step down in this gray column, will take South African corporate earnings down by about 40%. Now, immediately you might sit up and say, well, hang on, that 40 for an economy that is in much worse shape than the global economy, if the world economy is falling 5, we're falling 8. The world economy's earnings are falling 60. How come we're only falling 30 or 40? And there is a few things going on in the South African circumstance that are sources of relief, keeping in mind that this is JSE listed companies. So the first aspect is about 2/3 of JSE reported earnings are dollar-based. At the start of the year, the rand was 14 to the dollar. It seems like another world, another lifetime. But at the start of the year, the rand was 14 to the dollar. It's now trading around 17. So through that, there is a pull-through relief mechanism, and that your same dollar earnings or even your depressed dollar earnings are going to be multiplied by 17, not 14. The second is the commodities sector, although substantially smaller today than it was 10 or 20 years ago on the JSE, is still an important contributor to JSE earnings. And commodities have experienced a big recovery from the dark days of March. And through that, you have got a bounce up in commodity prices multiplied by a weaker rand. And so there's a relief mechanism there. And then the Naspers effect. That Naspers makes up 1/5 of the JSE, and Naspers is not reporting the performance of the South African economy and process also. They're reporting the performance of China generally, specifically in the world more generally. So they're not really capturing the South African experience. Be that as it may, what it doesn't change is the South African circumstance is tough. At the earnings level, at the economy level, and at the company level. And without delving into or dwelling on any of these, we've already seen a proliferation of companies going into business rescue with all types of implications for creditors, for equity holders, for employees, and more. What stands out in terms of the response to COVID-19 is the coordination and the extent of policy responses. The language quickly turns to, okay, if that's where we are, what does it look like in terms of the recovery from here? And to talk about recovery and the implications for investment capital markets, I've mapped here some data from McKinsey, which shows the size of the policy stimulus in a global financial crisis 10 years back. And you've got Germany, Japan, France, UK, so a nice raft of countries. And the solid black column is what was done in global financial crisis. This taller column, which absolutely towers over global financial crisis stimulus, is what policymakers have done in response to COVID-19. And this absolutely towers over the global financial crisis response. So that leads us to suspect that this is going to help the speed and the extent of recovery, making the obvious points that in global financial crisis, it really was the United States that did all the lifting. In COVID-19, everyone is lifting together, so it is global. The second is coordinated. It's not the United States followed by Europe, followed by Japan. It's everyone moving together. So you've got global coordinated policy that is elevated, and then it is monetary and fiscal policy. So it's government spending, tax relief, wage relief, wage support, employment support, and balance sheet support in the form of interest rate cuts. And South Africa has participated in that. So then if recovery is on its way, what is the shape likely to be? The left-hand side is the foot traffic measured in hyperop malls in South Africa. And this is the sharp decline in foot traffic, minus 70% year on year, foot traffic into the listed property companies' footfall. And there is recovery. But if anyone attending this webinar has been shopping recently, my suspicion is that even if you have been shopping, you haven't been spending in the same fashion as recently. So although there's recovery in foot traffic, the recovery in spend is unlikely to be as significant. On the right-hand side, this is spending in large cities in China, and you can see that 2020, this is not V. A V would be a bounce up. It would be, instead it looks more sort of L-shaped or maybe U-shaped if we want to be a little bit more artistic. This also is not a V. This is more of an L or a gentle U. And this is the recovery in air traffic in China. The top line is total air traffic. The bottom line is international air traffic. So China is moving people around internally, but still no external traffic. So this gives a sense then, if China was first in and China is first out, this is helpful in knowing what we can anticipate the recovery looks like. And it's not V-shaped economic recovery, which is somewhat confusing then, because the way markets have responded is that everything's okay. There's nothing to see here, folks, move on. A friend of mine who runs an investment firm in London, Dion Ghoos, puts a quirky tweet up the other day, and he says, it's obviously a sort of a tongue-in-cheek, he says, hi everyone, I've been asleep, I've been offline for the last 6 months. The last time I was online was in January. I'm back now. I see the market is where it started the year. Has anything interesting happened? And that's the market response to this is, let's move on. There's nothing to see here. And so the market response, represented by the S&P 500 here, has been V-shaped. That we are now into territory ahead of COVID-19. NASDAQ has gone into record territory. The JSE has recovered most of its losses. And this is an attribute that is shared globally, that there are very few economies that haven't rebounded substantially. When there's a couple that have been left behind. Spain is a case in point, and I've already suggested why that might be. So let's come back to the investment comments in a moment and just pause very briefly for a diversion to South Africa. Just 2 weeks ago, we had the supplementary budget where we were told about the Herculean challenge facing South Africa. I think this is somewhat disingenuous, that there is nothing Herculean about the way in which South Africa needs to get its arms around the problem. In fact, the problem is relatively straightforward. What's needed is action. And the Minister of Finance, Tito Mboweni, says our Herculean task is to stabilize debt. Well, yes, the Herculean task is to stabilize debt, but that is actually a consequence of an action. You stabilize debt if you stop spending. So South Africa's job is to actually stop spending and start growing. And guess what? If you stop spending and start growing, your debt will stabilize and your debt to GDP ratio will normalize. So I'm going to be uncharitable about the Minister of Finance's observation here and saying he's sort of stating the obvious, and he's not really laying out what the real problem is. The real problem is a government that is addicted to spending. And that addiction to spending is captured by, here's South African government spending as a percentage of GDP, and here's South Africa's tax revenue. Now, again, I'm going to sort of interfere with the Minister of Finance's words. He speaks about this as the crocodile jaws. And the crocodile jaws is the widening of spending versus income. And in our personal capacities, we know if we do this, if we keep spending more and more and more versus what we earn, and we look at our balance sheet, it's a problem. And it's called a growing debt to income ratio, which eventually you can't afford. And that's the territory South Africa has got into. We have moved into a debt to income or a debt to GDP ratio that is unaffordable. That's shown on the right-hand side. When countries get into this 50 to 60% territory, that's usually the time that ratings agencies are a little bit worried. When they get into this 90, 100% territory, this is what economists refer to as the point of no return, because your interest charges run ahead of your ability to service the debt. And so you get into runaway debt. And so here's Tito Mboweni's, the top of his hippopotamus jaw. And the suggestion is that they can moderate that debt and will actually get into this active solution, which will be far more palatable and that we can afford this circumstance. I said I was going to play with his words or his term. I don't think that this is a hippopotamus. I think that this is a crocodile. And the crocodile has some of the most powerful sets of jaws in the animal kingdom. The way that they kill is by clamping down. They don't let go. And they generally don't kill with the bite. They kill by grabbing hold of the victim and then taking that prey to the bottom of a water body where they drown them. And that is the reality that South Africa faces as an economy. And I'm not trying to be poetic or dramatic here. South Africa has got itself into an unsustainable position that requires dramatic remedial action. There's my throwaway is the job of economists is to depress people, so my work here is done. But let me be less flippant and more substantial by taking you to ways in which we might get out of here. So this very quickly, this data shows you what happens when countries get above 100% debt to GDP. And where the lines stop is that the country has defaulted. So South Africa, as things stand, is heading into default territory. And it puts us into the shape and nature of looking Argentinian, not yet Venezuelan. And Argentina, you know, it defaulted on its international debt in the early 2000s. It's getting back into the habit of defaulting on international debt. They're running with 50% inflation rate. The stats are, in fact, the IMF and World Bank say they don't believe Argentina's numbers. Argentina really has turned itself into a rogue state, not yet failed, but it's a rogue state. And South Africa is worryingly walking down that road. I've made this point about our interest charge as a percentage of budget. So every 20 cents, 21 cents of every rand we send in tax revenue now goes to servicing our interest bill. It is the single biggest item on the fiscus. Let me turn then to some slightly more optimistic observations and some realistic commentary about what we can do from an investment perspective. The optimistic observation is that what I'm telling you is not new or novel. There is nothing that I'm making in these observations that markets don't already know. The currency is one of the best ways of getting this barometer. And you can see what the rand did from the start of the year going into COVID-19, where even in February, perhaps early March, there was a prospect that if the world could normalize, South Africa's budget was still somewhat believable, and we might be able to keep the ratings agencies off our backs. Of course, that changed spectacularly, and there was a lot of hand-wringing that timing of the ratings agencies was appalling, that as we went into lockdown, Moody's called us into sub-investment grade. I think that that's looking past the fact that Moody's, S&P, and Fitch have been calling us out not for months or quarters, but for years on our spending and debt behavior. But yes, the timing was unfortunate, but it was actually our own doing. And with that, we got a blowout in the rand. You might remember the late March and April days of almost 20 rand to the dollar. And what's interesting is the recovery in the rand from then to now, where we're now hanging around in 17 rand territory. And there's two things going on. I'll share with you in a moment our rand forecast. The first is that this is spectacularly oversold. That at 19 rand to the dollar, the domestic currency was very weak, and it corresponded with what we were seeing in the likes of the Brazilian reais, Indian rupee, Russian ruble, and others. So the recovery that you see here has got less to do with South Africa than it has to do with a recovery in global risk appetite for emerging markets, and in particular commodity-based emerging markets. The second aspect that helps explain the improvement in the rand performance is that South Africa has access to a substantial global capital pool. By some estimates, at least 7 billion is immediately available, dollars is immediately available in emergency funding. And that will take the form of multilateral agencies, the IMF, the African Development Bank, the BRICS Bank, providing multilateral funding to South Africa's national treasury. And that provides some silver lining to what is a very dark cloud. How do we get that cloud not to lighten, but to actually clear the way and reveal a bluer sky? Our Minister of Finance needs to stop talking and start doing. And he knows what he needs to do. It sits in his 77-pager that National Treasury tabled at the end of 2019. And it's all of these structural reforms. None of them are what we would call radical. None of them are IMF imposed. All of them will help substantially improve South Africa's competitiveness. They would be good for business. They would be good for employment. They would be good for growth. The problem that South Africa faces is that we are in the habit with so much else. We're in the habit of talking about these remedies rather than getting on with them. And there really is low-hanging fruit here, including the likes of unbundling of Eskom, letting the renewable IPPs get underway. South Africa receives some of the highest photovoltaic irradiation in the world. yet we generate 98% of our energy from coal-fired stations. And the release of telco spectrum. And just look what happened in the first couple of days of COVID, that policymakers were galvanized into action to release some of this telco spectrum. So why not all of it? Why not more? The other silver lining is that South Africa has deep capital markets. And these deep capital markets provide some backing, even if it is inconvenient backing to South Africa's funding of our fiscal circumstance. I won't dwell here. I'll make this point very quickly and then finish up with some investment comments. What I'm alluding to in talking about South Africa's deep capital pools is that we have a pension fund industry whose assets represent about 100% of GDP. And just some small part of this pension fund industry being allocated to look after South Africa's fiscal strain could really take the thumb off South Africa's financial throat. The deep risk that we face in that is it is seen as an easy win and treated as free money. And if that happens, we run the risk of, well, in the background, I've got the Venezuelan picture. If that happens, we run the Venezuelan risk. So there is a very real prospect of doing substantial things here to remedy and relieve South Africa's financial circumstance, but it has to be done with absolute discipline. And if you're cynical about Guptas and Zoomonomics, then you will immediately recognize the anxieties and the concerns of going for this. But it is a prospect. So what does the outlook for South Africa look like? Well, economic growth for this year, minus 10%. These are quarterly numbers, so they average to just over minus 9%. We can call it minus 10 amongst friends. A recovery in 2021, but that's a dead cat bounce. And then very, very feeble growth going into 2022. Inflation stays low and stable for a long time. There's no inflation risk. And interest rates in South Africa, having been cut by 2.75% already this year, maybe a little bit more room. We think we're at the bottom in terms of South Africa's interest rates, and that we flatline for a long time from here, certainly without the threat of inflation. And then global interest rates following the same trajectory. I promised a brief comment on the Rand, and let me be brief here. We suspect that the Rand has got room to strengthen even further. 16.50 by the end of this year, and possibly into 15 Rand territory. This is not about South Africa becoming strong, but it's rather about that cocktail of some commodity price buoyancy, slight improvements in South Africa's economic growth, and the receipt of foreign funding, which would all support a Rand dollar and then a Rand conversion through the cross rates to other currencies. We think that 15 through the course of 2021 is quite realistic. From an investment perspective, what are the risks and what are the opportunities? This is my last slide. The risks take the shape of capital gains tax, a wealth tax, and marginal tax rates being lifted. The risks are that growth remains anemic and that South African companies, from an earnings and employment perspective, don't participate in the recovery, and that we keep talking about structural reform rather than doing anything. Real estate looks like it is going to be helped by interest rates, but held back by the supply-demand dynamic. The Rand is undervalued. Would actually be buyers of the Rand at 17 to the dollar. And South African bonds are very attractive, offering you on a longer term basis an 8% interest rate with 3% inflation. That's a 5% real return. I've made the point here, though, that there are huge caveats. And then from a global perspective, what does this mean for investors? Well, we've referred to zero interest rates as permafrost, that interest rates are going to stay at zero for a very, very long time. and that has anemic implications for cash and for bonds as asset classes. The US dollar looks expensive versus all other major currencies, but it's structurally strong, helped by Trumponomics. So November might change that. And there are some specific risks in posturing. For instance, the chest beating that continues between US and China, and the escalation that's going on between China and India. And then there's some really interesting positionings in countries that have not only navigated COVID, but are positioned well industrially for the recovery. South Korea and Germany stand out as country cases in point from an investment perspective. And then as a last point, we think investing in this environment is not you should do this, not that, but rather you should do this and that. So from a geographic aspect, US and China, growth from a recovery perspective, and gold from a defensive perspective, resources from an economic buoyancy perspective, and healthcare from a social welfare spend perspective. And that provides a different lens on how you think about allocating assets inside of your portfolios. Not or investing, but and investing. US and China, growth and gold, resources and healthcare. Then at the company level, what really grabs our attention is businesses that have been able to pivot. And I've given some examples here. I'll be very brief on this as a last point. If we take the example of M-Pesa, which is controlled by Safaricom. This is the digital payments business in Kenya. What they did was they waived all transaction fees in M-Pesa during COVID-19. Now that comes at material cost to M-Pesa from a revenue perspective and Safaricom from an earnings perspective. But from a customer traction loyalty perspective, this is the type of thing that marketing simply cannot buy. So that really interests us from an investment perspective. It's a lot of ground to cover in a short space of time. So let me stop there and thank you for your engagement. And hopefully there's a short gap for some questions and discussion.
Thanks, Adrian, and thanks for the insights. Definitely some food for thought on this side. As you mentioned, the work's not done yet. There's some questions that's been posted to us. First question is, where will interest rates go from here? Are there more cuts on the table?
Yeah, look, one of the pieces of work that we have in our modeling, Carl Ferreira, who's in my investment team, runs a very powerful, what's called a Taylor rule model. And the Taylor rule model is particularly good at forecasting interest rate moves and direction. And what the Taylor rule is telling us for the foreseeable future, absolutely nothing from interest rates. That they are, well, let me not say absolutely nothing. The Taylor rule is saying there is small room for maybe one more cut. And the forward rate agreements are also pointing to small room for modest cutting. And we're talking 25 basis points from here. And that would then be the bottom. So we're very close to the bottom of the domestic interest rate cycle. I'm going to be a good economist, really, and say this to you, though. There is a however. So in good economic tradition, the however is, however, recognize that South Africa is in deep economic stress. And the Reserve Bank could actually be encouraged from a policy perspective to go and take off the table the remaining 3% and a little bit in interest rates. And we would then join the rest of the world with 0% interest rates. So that's not off the charts. It's conceivable, but as things stand, as I can see things from here, I would say a prospect of a very small rate cut left through the last part of this year, and then no more. If we get into the world of deep economic stress, no structural reforms, and policy pressure is put on the Reserve Bank, it could be that we start to join the world of zero interest rate policy. But I'd put that as a 5% chance.
Thanks, Adrian. So in line with that, what is your best suggestion for investors in this environment?
That really is a it depends question. So, who is the investor? If you're an investor sitting on Mars and you're looking at the world, you would allocate less than 1% of your portfolio to South Africa on a market-weighted basis. So most people, I guess, on this webinar are substantially overexposed and overinvested in South Africa. That's a fairly common investment attribute. It's what we call home bias, that we tend to invest in what we know. But I would urge people on this webinar to think first about being Martian. From a Martian perspective, you would allocate less than 1% to South Africa. But then you need to bring this down to individual circumstances. So, an individual circumstance might be my in-laws who are in their 70s and going into retirement. And what do they need? They need income. And they need income in rands, and they can't take currency risk, because if the rand goes from 14 to 20 back to 14, their pension has just moved all over the road. So that's where you have to sterilize your risk and remove the currency. On that basis, then, things like South African government bonds actually look really, really interesting. South African government bonds offering you an 8% yield in 3% inflation, if you believe that government will look after the interest obligations on those bonds, and as things stand, we think that that is defendable, then bonds are really, really interesting. But it really isn't. It depends. The asset class that worries us most is real estate. The asset class that's going to be most stable, but will just hold its own, is cash. So, a 3 or 4% interest rate in a 3% inflation rate environment. And then South African equities have got a prospect of strong recovery, but you need to be very, very careful where you allocate inside of equities. Globally, I would stay away from cash and bonds. We think that they look really expensive. And I would have a hard look at specific countries from an equity perspective, or specific industries. At a country level, Germany, Taiwan, South Korea are standout countries.
Thanks, Adrian. That question has come through. Do you believe that gold is still a good investment given the current local and global environment?
Sorry, do I believe?
Gold is still a good investment.
That's a very cool question. What a cool question. In our global mandates, we hold a structural 5%, a strategic, that's the word I need, a strategic 5% allocation to gold. We've held about that exposure through all time. Gold you need to be very careful of. You can become a little bit fanatical about it. And very often, in investment meetings, when people start to speak about gold, most of the room sort of shuffles off to a place to get away from the fanatics. We are far more charitable. Gold is a psychological safe haven. But you don't want, and given that it is a psychological safe haven, you don't want to be all or nothing. Because it is psychological, what it means is it's going to be driven by behavior, by belief, by fear, by greed, rather than by fundamentals, demand and supply, of how much gold is there and what is the price of extracting it. So we've always held gold, 5% of our portfolio, and not in gold mines, but physical gold, 5% of our portfolio, that in an end of the world scenario, where we are dragging ourselves down a road with baked beans and shotguns, gold goes from $2,000 an ounce to $20,000 an ounce. It is a fundamentally, intrinsically valuable asset for times of terror and fear. So we like gold as an anchor in portfolios, but not all or nothing. And whilst I've suggested that we don't own physical gold, in our domestic portfolios, we do own gold miners. And our favorite gold miner is Pan African Resources, which is an extraordinary business. It brings gold to the surface at about $800 an ounce on average. And so you can think of the exceptional profit that Pan African Resources is earning in the current circumstance. $800 an ounce cost of gold multiplied by 17 Rand to the dollar.
Thanks, Adrian. I see we've got a few more questions coming through. What we'll do is this is recorded, and we'll also send a recording to everybody that's on this webinar currently, and then we'll answer some of those questions and we'll send through communication on that. I just want to end off with one more question. What's your view on tax rates? Do you think they will go up, and which tax category?
Yeah, I mean, you could have given me that as the first question, Renier. I mean, that's the hardest one. Almost impossible to say until we know really what the fiscus looks like. And as things stand with the supplementary budget, there was a lot of guessing going on with what the fiscus will look like. Maybe I could suggest this, that if they push marginal tax rates up, that's a bit like getting blood from a stone. I think you're going to encourage tax flight. If you go for corporate tax rates, so I'm putting a line through marginal tax rates. If you go for corporate tax rates, South Africa is already at the top end of corporate tax rates. And in a world where Ramaphosa is trying to still attract $100 billion in foreign investment, you can't square that up with raising corporate tax rates. VAT in South Africa is still modest, and it's got room to increase, but it's politically very unpopular going into another political cycle. I suspect that they will go for, if they are looking for tax revenue, they're going to go for a wealth tax. And they might go for, perhaps you recall, at the time of the democratic transition, we had that supplementary tax, we had the transition tax. You might remember that. I wouldn't be surprised if we see something along those lines, taking the shape of a COVID tax, that is a one-off tax that sticks around for a couple of years, which really is a tax rate increase, and then wealth tax, going for some form of balance sheet. It's hard to see how they finance this circumstance without going for additional revenue.
Thank you. Thanks for that, Adrian. And once again, thanks for your insights. It was really good, and I hope this is the start of many more webinars. We've got the opportunity to engage in similar issues. So thanks for your time. We really appreciate it.
Great being with you. Thanks to everyone for attending.
So to end off, as the opening of the economy continues, we know that the recovery will be impeded by lagged effects. We can only hope that the economy is able to sustain this tremendous pressure, and we are able to slowly rebuild. We would like to hear from you post this webinar, and should you have any more questions, please contact your Bidvest Bank Relationship Manager. Stay safe and healthy, everyone. Thank you.